Sure. So break-even ratio gives you an idea of how much your income can drop before you run the risk of not being able to pay your mortgage or go cash flow negative. And so, especially when you get into the multifamily world or the commercial world, this is a really important metric because your lender cares about it. And I'm a big fan of saying that if your lender cares about a metric, you should care about it as well.
The data scientist of real estate, George Roberts.
All right, welcome back, investors. You've read his books. You've seen him on Bigger Pockets. Today, I have the pleasure of interviewing Jay Scott. Welcome to the show.
Thanks, George. Thanks for having me.
Awesome. So you've done a lot of amazing things in your career. I have read many of your books. It looks like you've built, rehabbed, sold, lent on, or held over $150 million in property around the country.
It's crazy, but yeah, that's what I've done in the past 15 years.
Right. Not bad for a former IT guy, huh?
Yep.
All right. Well, I ask everybody this question. Is there any questions I shouldn't ask? And I think you give me the best answer. Like, let's forget about the how did you get your start questions? And I love that because I always like to launch into it. So let's just go into the A-list questions. Now, one of your recent books, I think it was just about 6 months ago, was about financial math. And I want to ask you, we're both from IT. To me, math is like second nature, but for many people, it isn't. So what can we do that would help to explode this fear of financial math today?
I think the biggest thing is simply using real world examples. And I'm not here to pitch the book. I don't want to pitch the book, but one of the things that we tried to do differently with this book, and I try and do differently when I talk to people about the math and the finance and the formulas, the metrics, is instead of just throwing out formulas, I'm trying to create context around those formulas. So using real world examples that allow us to kind of see how and why these metrics and formulas make sense and when they make sense. I often talk about the fact that we like to talk in answers. People read books because they want answers to questions. And I very much approach this last book from the perspective of what are the right questions to ask, not necessarily what are all the right answers. Because when you know the right questions to ask, it leads you down the path of finding the answer, and it leads you down the path of asking harder questions and being more inquisitive. And so it's the teach a man to fish sort of thing where, yeah, I could give you all the answers, but without the context and without learning how they work, why those are the answers, you're really not going to have any useful benefit for the future. And so it's really more about asking the questions and giving the context than it is about just throwing out formulas and numbers and math.
Yeah, I love it. Putting that context around the formulas. Well, do you have a favorite underwriting metric?
So it really depends. I don't have a favorite underwriting metric. And so again, it will depend on the situation and the type of investment. So certainly if I'm doing something transactional, so let's say I'm flipping a house or I'm buying and selling a note, I kind of think about deals in two buckets. There's the transactional deals, the stuff that you buy with the intent to add value in a short period of time and resell. And the bulk of your profit is made through what we call forced appreciation. Basically, you've added value and you've sold it for more than you bought it for. And then on the other side, there are those things that you buy and the value is derived from cash flow, from tax benefits, from paying down the loan over time. And so these are two very different buckets of investments. So on the transactional side, a lot of what I look at is ROI related. So what percentage of my money did I return on an annualized basis compared to what I put in? But then on the less transactional side, on the buy and hold side, that's when it gets more interesting. We've got a lot of metrics we can look at. So certainly there's this thing called cash on cash, where you see it's basically an indication of how hard your money is working for you, the money that you've actually put into the deal, how hard that's working for you, how many cents is every dollar that you put in returning on an annual basis. And so I'm a very big fan, are a lot of people of cash on cash return. But what a lot of people don't realize is that cash on cash return, we run this metric on a deal that maybe we're looking to buy in the near term. That's generally a good metric for the first year of ownership, but things tend to change quickly after that first year of ownership, or 6 months or 18 months, whatever it is. And suddenly this cash on cash return metric becomes less useful over time. And so I'm a fan of looking at other metrics that stay useful over time. So there's a metric called return on equity. And return on equity is very similar to cash on cash return, but instead of telling you how hard the money that you've put into the deal on day one is working for you, it tells you how hard your money that you have equity in the deal, how much money you have in the deal currently is working for you. Because one of the biggest advantages to real estate is the fact that we can use leverage, we can use loans, and loans provide us a couple huge benefits. And when done well, loans help us boost our returns. It allows us to not have to focus on opportunity costs. We can do more deals. And so return on equity basically gives us an idea of how hard our loans are working for us, and conversely, how hard our equity in the deal is working for us. And so if I had to pick any one metric on my buy and hold portfolio, I'd say return on equity is the biggest one. And I'll run that metric once a year, and that'll kind of give me an indication, is now the right time to be refinancing or selling the property versus continuing to hold it.
All right, great. Maybe I can throw out one of my favorite, which is your break-even ratio. Do you want to talk about that?
Sure. So break-even ratio gives you an idea of how much your income can drop before you run the risk of not being able to pay your mortgage or go cash flow negative. And so, especially when you get into the multifamily world or the commercial world, this is a really important metric because your lender cares about it. And I'm a big fan of saying that if your lender cares about a metric, you should care about it as well.
Yeah, great one, great one. Well, I also have some questions about maybe earlier people getting into investing. What do you think are some of the biggest mistakes that people make early on?
Yeah. So for me, it was not thinking long-term enough. I started my investing career in 2008. Between 2008 and 2016, I flipped 450 houses. I regret selling every single one of those houses. Had I thought a little bit more about it as I was going through, and I did keep a few rentals here and there, but I self-managed, and I would get frustrated with the management piece and I would sell them off. In retrospect, if I were to give my younger self some advice, it would be that I should have kept as many of those properties as I possibly could, because I look back and I realized, one, I lost a lot of money in appreciation. I don't bank on appreciation. We got lucky between 2008 and 2020. That wasn't necessarily going to happen. But in retrospect, it did. But more importantly, I spent a whole lot of money on taxes. I mean, if you think about it, if I'm paying 20% capital gains on the sale of a property, and with flipping, it's a lot more than, it's not capital gains, it's actually ordinary income. So I could potentially be paying 30, 35, 40% when you include federal, state, local taxes. That's a tremendous loss of profit. And so between the money I lost through lack of appreciation, the money I lost paying taxes, the money I lost by not being able to utilize amortization, which is basically the ability to build equity by having your tenants pay down your loans when you hold a property. All of these things it was a tremendous amount of money I left on the table by selling these properties quickly versus holding them.
Yeah, well, I love to see that transition where you're going from sort of a transactional approach to the longer term approach. And here, I just want to show one of the books that I've been reading. This is one of your earlier books, the book on flipping houses. Still a great book. And you got a lot of amazing stuff. I was just flipping through here. It's been years. This is possibly one of the first books that I read when I got into real estate. You talk about the importance of, for example, controlling your deals. I thought that was a great section. So great book. So if that's what you're into, great book. But you've also made quite a transition. I know now you've gone a lot into multifamily, and maybe I can just throw a little bit of a curveball. You said one of the things that you're great at is personal branding. You've switched your personal branding a bit over the years. So what can you tell us about personal branding and what you need to do when it's time to make a change?
Yeah. So, and it's funny, I wouldn't say that I've switched my personal branding. I have certainly switched my focus of my investments. I've certainly switched kind of the things that I talk about day to day in the investing world. But I like to think that my personal branding is somewhat decoupled from real estate. I think a lot of people tend to know me, or what I try and hopefully have a lot of people know me for is kind of the bigger picture stuff. So not flipping houses or buying multifamily. In fact, I like to say that I'm far from the smartest real estate investor in the room, most rooms that I'm in. But what I am is hopefully one of the smarter business people. I'm hopefully one of the smarter overall investors. I'm hopefully one of the smarter people when it comes to macroeconomics and how that impacts investing and our real estate and our businesses. And so I've always kind of tried to take a meta approach to investing and looking things from a higher level. If you want to talk about flipping houses, I can talk about that, but I think what people know me for and what I'd like to be known for is kind of the higher level stuff, the business, the macroeconomics, the scaling and growing and
That's wonderful. That perfectly dovetails with the purpose of this podcast, because I really love to build people up as real estate entrepreneurs. And I think there are so many real estate investors that do ignore that. And I think it's very much to their own peril. And glad that you dovetailed right into macroeconomics. I know you've been talking about some of the things that are going on. And why don't we just address the elephant in the middle of the room? We're recording this towards the end of April 2023. What's going on the macroeconomic scene, and how can that help you be a better investor?
Yeah, so let's start with the second question first. The importance of macroeconomics and understanding how economic cycles work, understanding economic history is simply that I'm a big believer that the best predictor of the future is the past. And we can look at the things that have happened over the past 50, 100, 150 years in both economics and real estate and where they've kind of intersected to see what's most likely to happen in the coming years, months, years, decades. And so that's the big reason why I think the topic is important, because it's the best predictor we have. I don't know where the market's going, but again, I can look back at the last 35 recessions that we've had in this country and see how they've played out. I can look back at the last 10 or 12 rate cycles and see how they've played out. And that's going to give me an idea of how the next recession is likely to play out and how this current rate cycle is likely to play out and what the timeframes are likely to be. So that's why I think it's important. As for where I think we are right now and what's going on, it's a tough question. It's actually a tougher question than it's ever been for me. I've been following economics for 2 decades now, and this is the first time where things really seem out of whack. And what we're seeing in terms of economic data is that it's somewhat decoupled from what's going on around us. So we look at interest rates going up and inflation to some degree going down. But historically, I mean, not historically, even just structurally, there's clear relationships between interest rates and inflation. And typically when you raise interest rates, inflation is going to go down. And so we've seen some problems over the last couple months, last year or two, in basically getting inflation under control through interest rate hikes. And so if that kind of that structural piece of our economy breaks, and we're no longer subject to the rules that we've been subject to for the last 150 years, or even much further back, what does that mean for where things are headed? If raising interest rates isn't going to stop inflation, well, what's going to happen? And then there's the bigger issue of what is raising interest rates in this current environment going to break as well. So a lot of our national debt, we have $31 trillion in national debt. A significant percentage of that is going to come due in the next 2 years, which means the government's going to have to issue new bonds, new bills, and they're going to have to issue them at higher rates, and they're going to have to pay more interest than they've paid in the past, which means the amount of money that we're going to be paying on our national debt over the next 2 years is going to skyrocket. So if interest rates stay high or even go higher, how's that going to impact the macro economy? So our national debt, and how's that going to impact our currency? Is that going to impact the dollar? Is that going to hurt our potential stance as the reserve currency of the world? And all of these things can kind of snowball. And so nobody really knows where things are going, but I will say that right now we're kind of on a precipice of something happening. I think we're heading into a recession. I don't expect it's going to be anything like 2008, but there are certainly a lot of things broken in the system that could change that.
Yeah, well, I love that you're focusing on the interest rates. I do think that is what is first and foremost in people's minds. And it is, of course, very important, right? One of the very biggest benefits of real estate is that you can finance a large proportion of the transaction. But what about housing? You know that we're way underbuilt. Where do you see that headed? I mean, this is something that clearly differentiates us from prior recessions.
Yeah, so we're underbuilt. There's not a lot of supply. There's still a decent amount of demand, and that's kind of propping things up. But at the same time, again, I'm a big fan of economic history. And if you look at the relationship between housing prices and inflation since 1900, there's been a very, very clear correlation. If you go from 1900 to 1997, basically housing values have increased at almost, I mean, give or take a few percent, almost exactly the rate of inflation for that 97 years. Between 1997 and 2006, we saw a huge deviation from that trend line, and housing values far exceeded inflation in their growth. After 2008, we saw a crash. And where did prices crash down to? Crashed right back down to that trend line. So if you go back to 2013, that was 113 years. We were still basically at that trend line of real estate values growing at the rate of inflation. And so since 2013, we've again deviated from the trend line, and we're well above that trend line. So the question is, at this point, if you truly believe that housing values and inflation are correlated, that means at some point we're going to come back down to the trend line. And there's two ways that can happen. Either we have a 2008 type event where the values crash back to the trend line, and we see a crash in values, or we see values kind of stagnate for the next few years while inflation catches up, and eventually the two intersect again further down the road. But I think either way, it's either going to be a drop in home values over the next couple of years, or it's going to be a stagnation in home values over the next couple of years. Inflation would have to be tremendously high for us to get back to that trend line anytime soon without a crash or a decrease in prices. So I do think the next couple of years are going to be different than the last few years. I don't think we're going to see this crazy increase in prices that we've seen, but whether it's a crash or just a stagnation, I don't think anybody knows.
Yeah, I think valuable perspective, and I hope people are out there listening. There's so many things you really need to do, I think, to be a good real estate entrepreneur. We've had such a long run up. I think that's perhaps one of the reasons that many people have gotten away without understanding finance, economics, business scaling in a much better way.
Yeah, certainly. I mean, you look in the flipping world, and back when I started flipping houses in 2008, you had to do a good job. You had to buy right. You had to do quality work. You had to spend as little as possible on the renovation, because when you went to sell, selling was really, really difficult. And if anything, when you went to sell, if you're talking 2008, 9, 10, when you went to sell, values were probably lower than what you estimated them to be when you purchased. Yeah. But between 2011 or 12 and last year, it was just the opposite. I mean, if you bought a house, if you paid too much, if you spent too much on the renovation, if you held it for too long because it took longer to renovate than you expected, actually holding it too long was good, because values probably went up. And the longer you held it, the more it would rescue you from all the mistakes you made. And so there are a lot of people out there that have been rescued by increasing values and time, and that's going to stop at some point soon.
Right. That is potentially one of the best things about real estate, is that if you can hold on, time does heal most wounds. And you did deal with at least 3 years then, or at least 2 years of declining prices as a flipper. That's very hard. That's usually when the flippers get drummed out of the game. Yeah.
Well, remember, when we talk about time healing all wounds, there are two types of deals. There's the transactional, where you buy with the intent to resell quickly, and then there's the buy and hold long term. Time will certainly heal all wounds on the buy and hold side.
Right.
If you can cash flow, if you can avoid losing the property, if you don't have to refinance, eventually in any given 10-year time frame, values are going to likely go up. And so yes, time is going to solve all your problems on the buy and hold side. But on the transactional side, if I'm not getting cash flow, if I'm not getting tax benefits, if I'm not getting amortization, basically I'm putting money out month after month in expenses and not getting anything back. Bad economy can destroy me.
Absolutely sage advice. When those home prices are dropping, that's like, I suppose, rubbing salt on the wounds to the transactional deals. Yeah, really tough. That's not a space I've ever been in, but I admire people who can do that. It's a lot of work. So then another thing that I noticed that you are an expert in is money raising. I know a lot of people would just love to be capital raisers. It's become quite the buzzword. It's something that's gotten a lot harder over, I would say, maybe the last year or so. What's your advice to people starting out in capital raising, or if you're trying to get to the next level, what can you do?
Yeah, so a few tips. Number one, be authentic. So there are a lot of flashy salespeople, marketing people out there raising money. And I think what we're starting to see is that those flashy money raisers that everybody knows their names, I don't have to say their names, people know who I'm talking about, they're starting to struggle. And a lot of it hasn't made big news, but in the industry, we're starting to see some of those bigger name capital raisers and syndication groups starting to struggle with some of their properties, not paying distributions, not doing capital calls. And so I think what we're going to start to see is that the emperor is going to be exposed without clothes. And we're going to start to see that some of the bigger names that are flashy sales and marketing people aren't necessarily the best operators. And so what I would first say to anybody out there looking to raise capital is you don't need to be one of those flashy sales and marketing people. Be yourself, be authentic. I'm an introvert. For me, doing podcasts or public speaking or anything is really tough. I'm the consummate engineer who would prefer to just be behind my computer screen 10 hours a day. So certainly like money raising for me could be very difficult, but it actually ends up being relatively easy because I focus on what I'm good at. I'm good at writing. I'm good at explaining. I think I'm good at explaining complex topics pretty well. And so I focus on teaching people and providing value and providing education and doing it in a written format. And if you do that long enough and consistently enough, and consistency is a big key here as well, people start to recognize that you are who you say you are, or you are who you seem to be, and people start to trust you. And trust at the end of the day is really the people that really the reason that people invest with you. And so for me, it's been building 15 years of trust through my writing and through my speaking and through trying to help people and trying to be a good force in the industry.
So I know you've also written a book about estimating jobs, and that really dovetails with physical due diligence. So you do physical due diligence, you figure out what's wrong, how much it costs. One of the things I really love is you have a sort of a top-down, outside-in approach. Can you explain to us, how would you approach, in a general, high-level way, how do you approach taking a look at a new building structure?
Yeah, so did you say a new build?
Well, not necessarily a new build, but more particularly if you're buying existing real estate. So what would you do? I love the specifics, but again, I like that outside in, top to bottom approach. I think that's a valuable concept.
So building is really just a collection of different components. And whether it's a single family house or it's a 300 unit apartment complex or a self-storage complex or a shopping mall, it's basically a collection of a bunch of things and things that everybody's familiar with. Plumbing and electrical and the roof and the flooring, and if it's a house, the cabinets and the countertops, the plumbing fixtures and the lighting fixtures and the landscaping and all of those things. And for each of those components, they can and should be evaluated independently. And so when I wrote that book, I basically laid out what I felt were the biggest 25 components of any renovation or any structure. And what I recommend people do is take each of those 25 components, look at them individually, basically do an inspection of each of them individually, figure out two things. One, figure out what's not working. So what needs to be remediated or fixed because it's just not working. And two, what should be upgraded just from a cosmetic standpoint, what just doesn't look good. So you can have cabinets that work perfectly, but if they're old, out of date, they might want to be updated. So make a list for each of those categories. Make a list of all the things that aren't working and all the things that should be upgraded. And then at that point, you have this long list of things, hopefully 25 components, maybe dozens of things that you want to fix or upgrade for each. And that's what's called our scope of work. That's literally the list of things that we can hand a contractor and we can say, hey, this is what I want you to go do in detail on this property. And then for each of those things on our scope of work, for each of those line items on our scope of work, if we want to know how much it's going to cost, we can break that down into what are the materials for that line item going to cost and what's the labor for that line item going to cost. For the materials, you can go online to Home Depot or Lowe's or Amazon, and you can see how much those things cost. And from the labor standpoint, you basically need to contact contractors or other investors and find out how much those things tend to cost. How much does it cost to replace a roof per 100 square feet these days? How much does it cost to install quartz countertops, whatever? And then you assign a labor and a materials price to everything on that list. So at the end of the day, for a big project, you might have hundreds of line items of things that either need to be fixed or updated. And for each, you have a labor and material cost. You add them all up, and that should give you a reasonable idea of what you need to do and how much it's going to cost.
All right. And then there are other things too that are maybe a little harder for a beginner, at least to identify. You can notice that the cabinets are out of date, or maybe you got a beam that's bowed. But what about inconvenient floor plans? I mean, that's something that can really cost you a lot of money, particularly with single family.
Yeah, absolutely. So I'm a big fan of saying, again, we go back to there's two types of things that you're going to do to a house. There are the things that are broken that need to be fixed. And then there are the things that are ugly or old and need to be updated. So we have resources for both of those. For the things that are broken and need to be fixed, for $400, we can hire an inspector to come in. Hopefully you have a good inspector. And basically their job is to go through those 25 components that I list and tell you all the things that aren't up to code, that aren't working, that are old and out of near end of life. And so a good inspector can provide a report, and that'll tell you all of the things that aren't working. And then on the other side, all the things that should be upgraded, and things like out of date floor plans. And maybe, for example, I remember buying a house that essentially had a lot of steps leading up to the front door. And it was in a neighborhood that tended to have a lot of families and retired folks. And I remember bringing in a designer who said, yeah, your buyer demographic doesn't match the type of house you have. There aren't a lot of buyers in this market that are going to want to climb up 30 steps just to get to the front door. And so bringing in a good designer can not only help you with things like, should I upgrade the cabinets, what color cabinets, what type of flooring, what type of fixtures, but a good designer can also tell you if you have an outdated floor plan or if there's something else about the property that doesn't match your potential buyer demographic, because that's a huge component.
Right. Well, you know what I like to do right now is go into the rapid fire section of the interview. And these are the 7 questions that I like to ask to everybody. Are you ready?
Let's do it.
All right. So if you could be known for only one thing, what would that be?
Being a good dad.
What's the greatest lesson in leadership you've learned as an entrepreneur?
Take all the blame, give all the credit.
What personal characteristic has been most pivotal to your success?
I'm lazy. I'm a big fan of the 80-20 rule and getting as much done with as little effort as possible, because I like my time with my family. I like my free time. And that's really forced me to figure out the systems and processes that will allow me to accomplish as much as I possibly can in as short a period of time as possible.
All right, we'll take a nod to the randomness in the universe and just tell me when to stop cutting the deck. This question could be anything from the trivial to the profound.
Okay, stop.
All right. What's the hardest thing you've ever done?
Hardest thing I've ever done. That's a really tough. I don't know why that doesn't seem like it should be such a tough question, but it is. The hardest thing I've ever done, getting married, was really, really hard. It basically forced me to become a whole lot more empathetic. It forced me to focusing on myself and to realize that there are more important things in this world than my wants and my needs. And that's been really difficult. I'd like to think I've been pretty successful at it, but yeah, that was tough.
Name a book that's helped to forge you as a leader and as an entrepreneur, and why.
There are a couple of them. Let's see, what do I want to pick today? Today I'll go with Thinking Fast and Slow by Daniel Kahneman. He's basically a psychologist researcher who studied how the brain works and how we think and formulate our decision. And it's tremendously insightful. It helps you. I'm a big fan of being empathetic and trying to put myself in other people's shoes. And it really helps you realize that not everybody thinks the same way. And the way people think is much innate as it is controlled.
Can you describe a failure or misstep and what it has taught you?
Yeah, I mentioned that I flipped 450 houses. So there was 450 mistakes right there. I learned that transactional income is far inferior to holding properties or investments long term. And to anybody listening, don't make that mistake.
Give us a quote to help forge our listeners as leaders and entrepreneurs.
I'm so bad at quotes. I'll go with Warren Buffett. Rule number 1, don't lose money.
And rule number 2 is?
See rule number 1.
Yes, I love that. That's a great quote. Yeah, Warren Buffett's a great standby. All right, well, the last thing I want to do is just make sure that people know where to reach out to you.
Yes, so www.connectwithjscott.com. That's my link tree, and I'll link you out to everything you might want to find.
All right, awesome, including opportunities to invest as well, I'm sure.
Absolutely.
All right. Well, thank you so much for taking the time to share your knowledge and experience with our audience.
Thanks so much, George. Really appreciate it.